Now that we have studied the rules of debits and credits, we can begin to record a company's different types of business transaction. The start of this process is to look what we call business documents. These items are evidence that a business transaction has taken place. It could be an invoice, it could be a check stub, a sales receipt, purchase order, but these documents are evidence that a business transaction has taken place. So our job is to record the information from these business documents into what's known as a journal. We're going to focus on the process of journalizing these business transactions, and we'll then talk about how to transfer data from the journal into another form known as a ledger account. So you ready? Let's go. So the journal is called the Book of Original Entry. This is the first place we're going to record our different types of business transaction. In the journal, you record the contract in chronological or date order. Okay? So when it comes to the recording process, we want to make sure that one, you record the complete effect of a transaction. So if I paid cash for supplies, I want to make sure that I record the entire transaction. If I provided a service and received compensation, make sure I record the entire effect of that transaction. And I'm going to keep those transactions in chronological or date order. Now, the journal should help to prevent errors from taking place. Because remember, we talked about the rules of debits and credits that they must do what? They must balance. So for every journal entry, the total amount debited must equal the total amount that's credited. Let's learn how to use this form known as the general journal to record our business transaction. Let's first discuss the actual format of the journal. First, you have your date column to record the date of each business transaction. Then you have the section known as the account title. We're going to list the actual accounts involved in each transaction, whether it's cash, supplies, accounts payable, account receivable, equipment. You get the picture. You're going to put the account titles in this section here of the journal. The reference column, I'll come back to the reference column in a few minutes. Then we have a debit column and we have a credit column. So what you're going to do with each of these transactions, you're going to ask yourself first, which accounts are involved in each business transaction? Are the accounts increasing or decreasing? What are the account classifications? And then apply the rules of debits and credits. So you ready? Let's go. For our first transaction, it says the stockholders invested $15,000 cash in a corporation in exchange for shares of stock. Again, the stockholders invested $15,000 cash in the corporation in exchange for shares of stock. That's one transaction. Your job is to analyze that business transaction, meaning you want to first identify which accounts will be involved in this transaction. Well, the accounts involved would be cash, and it would be common stock. All right. Next, ask the question, is my cash account increasing or decreasing? Cash is increasing. What about common stock? That account is also increasing. So both cash and common stock are both increasing. What type of account is cash? You say assets? That's correct. Good. And assets increase on what side? Excellent. Assets increase on the debit side. Common stock falls up under stockholders' equity, and it's also increasing. Common stock is going to increase on the credit side. When using the general journal, whatever account you're going to debit, you write that account title first in your journal. So I'll put the cash account title first and record the amount on the debit side of the journal. I'll then come back to the account title section. Notice that I'm going to indent, then write common stock and record the amount on the credit side. So when you utilize the general journal, whatever account you're going to credit, we're going to first indent, then write the account title and record the amount in the credit column. Every transaction must do what? It must balance, and it does. The total of the debit side equals the total of the credit side. You now recorded your first business transaction. Next up, we purchased computer equipment for $7,000 in cash. Your approach remains the same. You want to get identified which accounts are involved in the transaction, determine if the accounts are increasing or decreasing, what are the account classification, and apply the rules of debits and credit. So we have two accounts, computer equipment and cash. They are both asset accounts. My equipment account is increasing while my cash account is decreasing. The rule says asset accounts increase on the debit side, asset accounts decrease on the credit side. In your general journal, whatever account you're going to debit for each transaction, write the account title first. So my equipment account goes first, record the $7,000 on the debit side. I'm going to indent, write my cash account, record the amount on the credit side. So we could have made this one entry, but I wanted to itemize it right now so that you have a better understanding of how to record your business transaction. Want some more? Okay. Next up, July 1st, we purchased a delivery truck costing $14,000. We pay $8,000 in cash now and agree to pay the balance of $6,000 on account. Now in accounting, we have a lot of terminology. That's why the reading is so important. We need to understand, what does on account mean? It means that we have not paid the full amount for the truck yet. We still owe them $6,000 that we plan to pay at a later date. So you ask yourself, which accounts are involved in this transaction? You have your truck account, you have your cash account, and you also have a payable account because we still owe $6,000. The truck account is an asset, it's increasing. Cash is an asset, it's decreasing. And the payable account is a liability that's going to increase. Now apply the rules of debits and credit. The equipment account goes first because it has been debited. The account to be debited is already written first in the journal. So we have the account title, record the $14,000 in the debit side. Then I'm going to indent, write the cash account title, and record the amount of $8,000 on the credit side. And last, my accounts payable account. So notice that they're both on the credit side, so they're right up under each other, and I record the amount in the credit column. So if you did accounts payable first and then cash, that's fine, because both accounts are shown on the credit side. It doesn't really matter which account is written first. But notice that there's one account on the debit side, two accounts on the credit side. This is known as a compound journal entry. Compound means you have more than one account on the debit side and or you have more than one account on the credit side. It is not the number of accounts, but it is the dollar amount that must balance. The total on the debit side equals $14,000. The total on the credit side equals $14,000. Therefore, this transaction is in balance. Okay? Look at a few more transactions. First, it says that we open a bank account and deposit $20,000. So the owner made an investment and deposited $20,000 into his or her account. So you want to ask yourself, which account will be involved in this transaction? Well, we have cash and we have common stock. We're going to put the cash account first because it's going to be debited. Cash is an asset and is increasing. Assets increase on the debit side. Common stock falls upon stockholders' equity is increasing. Equity accounts increase on the credit side. Next, we purchase equipment on account to be paid in 30 days. So we haven't paid for the equipment yet. The accounts involved will be equipment and accounts payable. The equipment account being an asset, increase on the debit side. Accounts payable is a liability account. It will increase on the credit side. Then we interview 3 persons for the position of a hairstylist. How do I record that transaction? You know, that's not a business transaction until we actually hire them and they start providing actual service for our company. So only those first 2 transactions require an actual journal entry. Almost there. Next up, after you record the transaction to the journal, you're going to post them to what's known as the ledger account. Each account title has its own individual ledger. The purpose of the ledger is to keep a running balance for each of our account titles. So cash, supplies, notes payable, accounts payable, common stock, retained earnings. Each account title has its own separate ledger account. Here's an example of a ledger account for the cash account. These amounts here are coming from the journal, general journal, and it's showing the actual date for each of those transactions. So if in the journal I debit my cash account, I record it on the debit side of the cash ledger account. After each transaction, determine what is going to be the current balance in that particular account. And we do this for the entire accounting period so that I always know how much cash is available. Let's look at one example of how to take data from the journal and put it into the ledger account. That's a process known as posting. On the first, my cash account was debited for $15,000. Therefore, in my cash ledger, I'll debit cash for $15,000, and my balance would be $15,000 at that point in time. Notice in the reference column in the journal, it says 101. 101 is the actual account number assigned to my cash account. 311 is the account number assigned to common stock. So once you post a transaction into the appropriate ledger account, you're going to record the account number in the journal in a reference column. That is to indicate that these transactions have now been posted. So here we went through the process of recording transactions to the journal as well as posting to the ledger accounts. Okay? Feel free to contact me with any questions on how to journalize transactions or how to post to the appropriate ledger account.